Good afternoon, everyone. Welcome to our webcast today on short verticals. I'm Connie Hill. Happy to have you join me here today, and I'm happy to be here. You know, one of the most recent requests that I've had from several of you is, what do you do to a trade that maybe doesn't go your way? Can you fix it? Can you salvage it? What can we do to repair it? Well, we're going to get a deep look into that today as we look at a couple of our trades and what happened since we got into them last week and how those unfolded. All right, and that'll kind of give you some light about what we could potentially do. Now, I hope you're following me on X. I'm Connie Hill CS. We have the pleasure of having Brent Moores in the chat with us. Brent's going to help me field some questions that maybe I can't get to. Thank you, Brent, for being there. Brent does a lot of fun posting as well. You'll want to catch him at Brent Moores CS. All right, it's free, it's easy. You get little nuggets throughout the trading day that we might send to you. And it's a good way to be able to have contact with us in between our sessions. Now let's go through some brief disclosures and we'll get going on our agenda here today. As we do that, I just want to give a quick shout out to several of you that are great to be here early and on time. Welcome to David, Paul, Frank, R.E., Scott, Johnny. Happy that you're all here. There's many others as well. Let's go through those disclosures. Options carry a high level of risk and are not suitable for all investors. What we talk about today should be intended and as information and education, but don't consider it a recommendation of any sort. We will be using the thinkorswim downloaded software application. Sometimes we'll refer to this as our paper money, where you have a live market, but money that isn't in a live account, it's just in a fake account so you can practice. It's great to use that for educational purposes as well. Vesting involves risk, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. An in-the-money option has a higher risk of being assigned early. One thing you need to know is that paper money does not assign early, and that's different than the live market. Okay, so we like to make you aware of that. Past performance of any security or strategy does not guarantee future results or success. Now, we've got some live events coming up. We've got several for you this year. Coming up first in Scottsdale, Arizona, March 7th and 8th. If you are nearby and can get over there, you'll want to do that. Chicago is March. That'll be an advanced options workshop for those of you that may be a little bit more advanced. Understand it might be getting close to being full. So if you're interested, get registered right away. And then, of course, we'll have Detroit and many others. You can go out to our Schwab calendar and see when those dates are. In fact, I'm going to flip over there real quick and show you and hopefully get rid of the horse in my throat. Excuse me. Oh, that's even worse now. Just a moment. Okay, that's better. I'm back. Thank you for the slight diversion. Now, if you're logged into your Schwab account, what you can do is you can just come over here to learn and then come over here to Schwab coaching. And then you will see our calendar of our webcast, which many of you are probably familiar with. But if you go into this one here on the right, in-person events, that's where you can see the calendar of those upcoming events. So we want to encourage you to attend. You will love it. You will thank me. I don't know if you'll thank me as much as maybe bringing me a pie or something like that, but you will definitely enjoy it. Now, in our class here, it's an intermediate level class, but it's helpful to maybe go over some of the principles of short verticals. Not everybody here is a big expert on short verticals, so I like everybody to be able to follow along, so we'll talk about some concepts there. One of the big keys today is talking about trade management and this idea of what do you do if the trade doesn't work out? We're also going to do kind of a part 2 series on watching time decay. We focused on that last week, and we're going to do some continued follow-up on that today as we look at a lot of different examples. All right, let's head over to my thinkorswim. And let's go over to the charts. You guys know what's been going on in the markets, right? You've witnessed the whole week of a lot of volatility. And we met last week. This was, let's see, that was Wednesday the 19th. So we met on this day here on the 20th. And then, of course, since then, we've had some red candles, some significant pullbacks in the market. We're going to look at one thing here today. I want you to look at today's candle as I zoom in. Ooh, that's a little too zoomy. Let me try something else here. Let's just kind of reset this. Come on back. It's being a little ski-wampus here on me. There we go. We'll just focus on this candle. Those of you that know candles know that they kind of can give you some up-to-the-date information about the price action of the day. And so earlier in the day, the market was down quite a bit lower than where it is here, right? It got clear down here. And then it's kind of been a little bit all over the place. It looks like right now, man, it's really close to going positive, but not quite there. But kind of as the days gone on here, we're seeing the bulls push those bears back up and seeing that price on the index recover. Now, that's important for a couple of things that we're going to take a look at here. Now, I want to direct your attention over to my scratch pad for just a minute. And I'm going to pull up an option that will expire today. Today's the 27th. And what we did last week is we just looked at an SPX call strike. We were looking at 6,100, which was about quite a bit lower than, a little bit out of the money than where the index is now because of the drop. But we looked at this column here. That is our extrinsic value column. We talked about extrinsic value is time value. How much time is left in that option? And we just kind of watched one. Okay, we watched that 6,100 strike. It started out with extrinsic value of 441. And then throughout the class, I kind of did some documenting. What was the value of the extrinsic as time went on? Now, most time it dropped. Not every time. This fourth reading we had here, extrinsic value went up to 364 from 220, but then later at the end of our class, it got down to 227. And then 5 minutes before the close of the market, it was down here to about 20.26 in terms of the value of that extrinsic. So we basically watched bleed off a little bit more than $4 of intrinsic value. Now we're going to take it a step further today, and again, we're going to do some more checking, but we are going to put together a spread, and this is just so that we can just see a little bit more, kind of another step down the path of watching time decay. Now I'm going to pull up here a very short-term chart. Okay, want to see just in a 1 day, 1 minute chart. So this activity here is actually yesterday, because on a 1 day, it kind of shows you the previous day and then starts building on for today. And then today's, here's the price action, right? SPX gapped up right at the open, and then we had a lot of selling off, right? And as we look at it right now, it kind of looks like maybe these highs for the day are getting a little bit lower, and our lows for the day are getting a little bit higher. I could draw a little triangle pattern on here if I wanted to. So looks like price action is compacting a bit. Now, if you had to choose, oh, should we put on a spread? Should we put on a bearish spread or a bullish spread? You might be a little bit torn because of this consolidating that it's doing, forming this triangle here. But we're going to put one on just to watch. Now, because man, that is really tough. I was going to say, because it looks like maybe it's a little bit more bearish right now, we're going to go with a short call vertical. Again, this is for the purpose of documenting how quickly that whole value decays from the moment we sell it. All right, so coming over here to the trade tab, I'm going to go quite a ways out of the money. And we're using the 0 days, meaning they expire at the end of the day today. And I'm going to go back out here. I'm going to actually go to a 12 delta. And let's see if there's much premium to gain here. Let's do a sell vertical. It's just going to bring it up here. And so we've got that short leg at about what, 59.75. And so in an ideal world, we would want the SPX to stay below 70 or 59.75. kind of pretty close to where my mouse is. And that is, we've got some points away from where the current price is at 59.45. Okay, little bit of leeway there. So we're just going to watch it. Okay, so again, I'm going to bring it up, and we're just going to go ahead. We're just going to do one contract here. We'll go ahead and get filled at about 40, I was hoping 45 cents there, knowing that we would love for it to kind of stay below that short strike price. Okay, so into the next step, we're just going to do one contract. We're going to send that off, and then we're going to watch it over in our monitor tab. Okay, so it looks like we probably got filled at that 45 cents. And so we're just going to kind of watch this little trade, check back on it throughout our class. All right. Next up, I wanted to show you and answer the question, what do you do when something goes against you? We put on some bullish positions last week, right? The market was still quite bullish. It set a new high. And shortly after doing that, what happened? Man, we got a big sell-off in the market. So we had several positions out there. What happened with them is pretty much the same thing with each of them. This one I'm going to pull up here that's going to be our first one we're going to talk about here is OKLO, OKLO. And I've done some drawing on my chart here. Let's go ahead and zoom in. We got into this trade. It had been upward trending pretty significantly. It had a pullback, and at the time we got in, the idea was maybe it's finding support here and giving us a hammer candle. So we said we would be interested in doing a bullish trade. Well, then the next day, man, we got slammed. Now, when you're doing a short vertical, sometimes it's helpful to have a little bit of patience. In fact, I call them trades of patience. But when you have a technical breakthrough, when you see a violation that you're like, oh man, this stock is not doing now what I thought it was going to do, whenever that time is, some people might decide to get out of the trade. We still have time left on these. I think these were March 21 options, all of them that we had. And so we entered them here, or there was a couple of the trades we had done the previous week as well. But on Monday, when we still had a gap down in the market and some continued bearish movement, it was like, okay, this trade is not working out. We are going to do the reverse of polarity. We have a bullish trade going on. We're going to turn it into a bearish trade. So with the short put vertical, what we did is we said, fine, I'm going to go buy back that short leg for a big loss. Okay, and it was a significant loss. And then, man, we're going to hope that long put makes up the difference in the trade. Some of them it did, some of it didn't. Okay, so what I've got going on here, we got into the market here on Monday when it gapped down. That's what I did. Went and bought the short puts back and held on to the long ones and was like, okay, baby, you run and make up the distance for us. Next day, what happened? Stock was down, or index was down again, as well as these stocks, and this one in particular, and it got clear down there quite a ways. And then about 2 hours before the market closed, what did we start seeing? We started seeing the rally back up, and a lot of stocks and the index was looking like it was going to develop a little hammer candle. Well, with a little hammer candle, what does that indicate? Potential reversal, right? And so in this case, when we were just going with our long puts, we had to change our rules. We weren't using short put vertical rules anymore. We were using our long put rule. Okay, trading plans that we use. For signs of reversal, we typically want to get out if we've got a long call or a long put. In this case, it was a long put. So starting to see signs that the market was recovering was enough to say, we better go. Just get out of these trades, get out of what we can. Okay, now I wish I had been quick enough to take a picture of this before I closed these all out, but I didn't think of it in time. Okay, so this one's our OKLO trade that we're looking at here. I'm going to tell you what the numbers were, but you can see on each of these positions for the day, and this is after I closed them, that some of them were up significantly. But what this doesn't show, and you kind of have to do it on your own in shorthand. It's great to have a spreadsheet or a trading journal that you can go through leg by leg, say this is what this transaction was, this is the credit we brought in, oh, we went and bought back the long put, oh, this is how much we're down on the trade, oh, when we finally sold it, this is how much it was. This is only showing the legs that were on that day. So it wasn't accounting for the losses when we bought that short put back, okay? But interesting, it's like, okay, you start seeing the numbers were bigger when I started seeing the bulls start pushing back up against the bears and started seeing those longer shadows develop. So I'll just tell you real quick as we get back to the chart. Initially on this one, we brought in a credit of 36 cents on the 20th, this day. On the 24th, when I went and bought our long or our short put back, just kept our long, that short put, we bought a significant loss. We had to go buy it back for $4.90. And so between our 36 cents and our $4.90 loss, we needed that long leg to make up in the neighborhood of $5.54, because that's what we're actually down. Now, none of these numbers include commissions ever, okay? You know to factor in your commissions on top of that. When we were able to buy this back on this day, we actually were able to buy it back for $7.20, okay? So at the beginning of the day, that whole position with everything accounted for was down. I'm going to put a little minus in here, down $4.54. And I don't know if it kept that little minus there. So I'm just going to say minus. And then at the end of the day, we bought it back for $7.20. So that's not correct math. So let's make this number work properly. Minus $4.54 plus $7.20. There we go. We ended up per contract up $2.66. Multiply that by what? 100. And then you have to multiply that by however many contracts we had. And in this case, we had 22 contracts. Okay. And so ended up that we had a pretty decent gain in this, but we didn't know that at the time. Okay. So we had to make a lot of quick decisions when our support was violated. When it was obvious that, man, we're having a whole market sell-off and it is sucking all our profits away. Okay. And then on the reversal, you know, if I'd been off for something and not paying attention to the market, I would not have been able to come back in here on this day and sell. So when we do that reverse of polarity, just know you've got to stay on top of it. It doesn't always work out. But sometimes, like in this instance, it did. The one that didn't, we actually lost some money on, was on Shopify. We'd gotten into it 2 weeks before our class, right? Got in on a nice little hold entry here. It's looking lovely, right? Bullish for a couple of days. Then we get the big sell-off in the market. So same thing here. On Monday, when this thing was really dropping, bought back the short put, kept the long one, and was like, okay, try to drop for me. Or us. It was our trade together. So our initial credit was $1.36. When we bought back the short leg on Shopify, we had to buy it back for $10.20, which left us a big negative that we had to make up. It left us a negative of 8.84. Then on this day, when the market started rallying back up and I saw those profits dwindling, okay, from that action, we went ahead and sold it, okay? We did not make our money back there. I had to sell that for $7.95, okay? Oh, darn, my thing went the wrong direction again. All right, so just say 884 minus 795. Okay. I don't know why. I think maybe I have to click this twice. Let's try it 3 times. Okay. Basically, 795 is what we sold it for, and that was kind of going against our 884. Anyway, it was a loss. Okay. I don't think that number's correct there either. But in any case, we ended up with a loss. We had 4 contracts. So the loss, oh, that is right, of 89 cents times 4 contracts, we ended up being down about $356 on that particular trade. So it doesn't always work out, but you do have some options to try if things change on you. Okay, if there are little changes, you know, some vacillating a little bit, you're probably just going to allow it to play out because they're trades of patience, and we put it on as a high probability trade. Okay, just know we have no positions left. Okay, and so we're going to do something in our portfolio. All right, now I'm going to go back to our SPX chart. I'm going to go back to our 1 day and 1 minute. And looks like what maybe a little bit of pulling back in the SPX. Is that going to be boding well for our trade that we put on here? We'll just go check. We're up a little bit in it, so it's helped a little. All right, let's put on some brand new trades here. Let me look at what LG Realty Group is saying. Oh, I'm going to let Brent help you out with that. It looks like he did answer that question for you. No problem. We want you to ask questions while you're here. You bet. All right. Now, the question is going to be, do you feel more comfortable putting on bullish positions or bearish positions at this point? It might be that you have a case to make it either way. The first one we're going to do here is going to be bullish. Okay, let's see if it's still, this is bullish enough for us to pursue this opportunity on. And we did previous trade. We're out of that now. Probably should remove my little drawing there. Nice earnings, gapped up. Stayed at, it really held the bottom of the gap there until what day? Until Friday, right, when it first kind of sold back, or sold off, I should say. But this stock's recovered quite nicely. You might be looking at this and go, well, it still had a higher high. It still has a higher low. And today, maybe by the end of the day, it's looking like it right now would have a hold. Our low day is here. We didn't get a close above it there. We didn't get a close above it there. But today, it looks like things continue the way they are, that it would have a hold type entry. So we're going to go ahead. We're going to do a short put vertical on this. Now, when we do and construct these trades, we're identifying first the leg we want to sell. Okay, it's the biggest driver in the trade. And so we have some particular rules around, well, what leg should we sell? Now, many times, first of all, time frame. How much time do you want to sell? If you have a stock that has a lot of weeklies, you have a lot of choices. This one doesn't. So we're just going to go with March 21. Many times traders like to target between 20 to 40 days worth of time. Sometimes it goes up to 50 days worth of time. So we're kind of at the lower end of this. But I wanted you to see, to have a little bit of volatility priced in here. Yeah, it's a little bit higher, a little bit more volatile of a stock because it has been doing some really, some moving. It's been moving around quite a bit. All right. Now, we're going to use our delta column, or we're going to focus on our delta column to determine the strike price we're going to sell. Let's see if this still seems to make sense here. I was looking at going 75.70. I was looking at the open interest contracts here. Would love to be where there's a whole bunch, okay? If you were feeling more comfortable at the 72.50, there's a few contracts there. If you were, only selling 5 contracts or so, you'd probably feel okay. All right, but let's see what it looks like here. If we say we are going to sell the 75, and then let's change this to our 70, and I'm going to lock in that credit. That's a pretty healthy credit. Knowing that that's the case, some of you might opt to go out a little. So let's just see. What if we did instead 72.50 and did 72.50? That's the 26-27 delta. And then maybe spread out. Maybe we change this one to this. We could leave it at 70. It's got quite a bit of open interest there. We could do a $2.50 wide spread for 60 cents. I'm actually going to lock this up here. That would give an opportunity for a higher probability to expire out of the money. Right now, that's sitting at 69%, versus if we did the 75, it would be about 58%. So 60 cents on a $2.50 wide spread is a number that many people might be comfortable with, okay? Because you would say, okay, our max theoretical gain is 60. Max theoretical loss is going to be 250 minus the 60. So we've got $1.90 there. And if we divide that, it's about a 31% return on a 27 delta stock and a 69% probability. So guess what? It's moved enough. We're just going to go for this one here. We're going to do the 72.50.70. Oh, somebody is wanting to have the script on the chart for those labels at the top. I will do that. I don't have them copied over in the chat, but after we finish our trade, I'll go ahead and we'll do that. Now, if we can risk in our account here, our class example account, $1,500 per trade, let's go ahead and put in our $1,500. We're going to divide that by our potential risk in the trade. What did that turn out to be? Was that $1.90? Did I do that right? 190 plus 60 is 250. Yeah. We could buy 7 contracts. Okay. We're chopping this off. We're basically dividing it by 100. Okay. So we're going to do 7 contracts. And something that I think is helpful to do is to put in your exit order or an exit order at the same time. And many times we'll try to get a chunk of that credit. Say if we have the 60 cents, and if we get 70% of it and there's only 30 left, then let's go buy it back for 18 cents here. Okay, so we're going to create an opposite order. I did change this down here to first trigger sequential. We're going to put in that 18 cents. All right, we're going to make it until canceled. Yeah, we're going to try to get filled at this price. I should maybe just check. Maybe we can get it better. Well, a tiny bit better. We'll see if we can get it at 62. All right, we're going to let that fill. We're going to move on. Now, let me go out. Let me answer that request. And I think what the request is here, these labels at the top kind of show what's been going on with the stock. So year to date, man, this stock's up 47%. There's a big reason why there's some volatility priced into the options, because this thing has been moving. Let me go to my studies. And it happens to be this Think script here. And we have some really smart people that create those Think scripts. Let's go to the little script. I'm going to hit share. And I call this one, I call it year to date, month to date, week to date. So letting me know, hey, those are the labels that are going to be shared or that are going to calculate for us. I'm just going to call this labels percent. Okay, you name it whatever you want. All right, going to go ahead. I'll share this with the group. And for those of you listening on the archive that are interested in this as well, I am going to post it in my notes. Close this first. I'll post it over here in my notes. And go ahead and hit pause, zoom in on it so you too can have that calculation. All right. It's very handy, isn't it? AJ had asked a question here about what is higher, how much the number should be to call it higher. I think, AJ, that question may have come in when we were talking about the chart on the stocks we were looking at, the trades we had in. And many times what I'll look for when we're talking about higher, is dominant peaks, dominant troughs. Okay, so I would say, here's the low at that point in time before they had earnings, rallied up, so made a new high up here, did a couple days there quickly, pulled back. So this low here is higher than the previous low. Okay, so that's what I'm looking at, not necessarily micromanaging the candles day by day, but just noting where are the big bouncing points and maybe bouncing down as it sees resistance. Okay, hopefully that answers your question. Oh, the question JJ says, actually, what about volatility? Okay, if it's high volatility, I'll give you my rule of thumb. I was going to say, I have a little sticky note on it that I refer to sometimes. I think the range I've got in here is still pretty decent. Anything that's above 35 is what we might consider high. 25 to, say, 34 is kind of medium. And then we have some that are huge, right? So anything above 35 could be huge. And so something like 15, you see something in that range, it's pretty low volatility. Usually doesn't have a high beta, usually might not have juicy premiums. Okay, so I appreciate that question there, AJ. Thank you so much. All right, let's take a look at our next one. Let's see how this guy is looking right now. They kind of spied these trades out earlier in the day. So we'll make sure that they still meet a technical criteria that some people might like. Now, this is Gilead Sciences. And you can tell, obviously, it's been on an uptrend. If I were drawing on the chart, I might say, hey, look at this nice flagpole. Look at this nice 2-day pullback. Nice little 2-day flag. What's it doing today? Boom, breaking out of the flag structure. Okay, so we're going to use that as an entry. And it looks like it's hanging on to the price it is right now. The expected move, if I duplicate the flagpole, we can either drop it here at the end of the flag, kind of that far edge for a more conservative target, or you can put it here at the breakout zone for maybe a little bit more aggressive of a target. We'll be a little bit more conservative. And given that we're going to be doing a short vertical, we might not necessarily try to get up to the top of this flagpole like we would if we were maybe, say, buying a long call or buying the stock outright and doing a swing trade on it. Okay, but it's good to have that technical idea in mind of where we think the stock might be going. All right, so on Gilead, we're going to do another bullish trade, and it does have some weeklies. They're not as liquid, so we're going to use the March 21s here. And strikes that I was looking at here, let's see if they still make sense to do. Let's see, on our delta. Let's go here. I was looking at maybe something down here a little bit lower. I was looking at our 110 strike price and kind of spreading it out a little bit. I'm looking at this open interest here, and I kind of wish it was a little bit higher here. At 109, there's only 34 contracts, under 60 contracts. So what we would probably do here is just do 110 and 105, okay? Spread it out by $5 so we have lots and lots of contracts that we're working with, because that makes it easier for your fill, makes your bid-ask spreads more narrow. Spreads that are narrow, we love, they're juicy, we look for that specifically, okay? So we're gonna go ahead and sell the vertical. And we're going to change this. So I'm going to change that to the 105. And I'm going to go ahead. We're going to work with even numbers here. We're going to lock that. Okay, could vacillate here a little. So $1.25. That would be our maximum theoretical gain on this. What would we be risking? We would be risking $3.75, right, per contract. So some people say, okay, let's do the math. Let's make sure that it gives you a good enough return. And some of you, if you've been doing verticals, you're like, you know what that number needs to be on a $5 wide, okay? When you're newer, it doesn't necessarily come to you automatically, but after you've been running a few, then you'll start to notice that you can pick up on that just fine. So we're gonna go $1.25, divide that by 375. That's about a 33% return. So some people might look at the number of days left before it expires, which is 22. If somebody were doing a small number of contracts, then they might be a little bit pickier, I'm going to say, and maybe choose something in here where they can do a really narrow spread, like a $2 wide or $1 wide spread, okay? Depending on the account size, somebody might need to do that, okay? So just know absolutely valid to do it that way. Now, 375 is what we would be risking per trade, per set of contracts. So we'll take 1,500, divide that by 375. So we can do 4 contracts here. That's what we're going to do. And we're going to do the same thing where we say, go buy the trade back. Let's put in an exit. If we get a chunk of this, we're not going to be greedy. We're not going to say we need every single ounce out of it. But we are going to say, if we get a chunk, let's take the chunk and buy it back and be done with it. Okay? Once you've got a lot of that percentage, you actually have a lot of risk because you might lose that, right? Holding out for the last few pennies on it. And so that's why some traders just don't choose to do that. And in the class, when we're teaching this, yeah, I'm absolutely going to go ahead and follow along with that, okay? So let's say of our $1.25, let's go this time with, let's say, 75%. First one we did 70, we'll do 75 on this one. That means 25% would be less. Multiply that by 0.25. It says, okay, go buy it back at 31 cents. So first trigger sequential, create an opposite order. I'm going to change that order to exit to 31 cents. I'm going to make that good till canceled. And we're going to send it on its way. And I should have been putting it in our basket here called short bull calls, short put verticals. There's a lot of different names for it. All right. Now, there might be some of you that are like, I'm feeling a little bit more bearish, Connie. I ran my scans that I like to run first thing in the morning, my early morning movers, bullish scan, early morning movers, bearish scan more recently. And the stocks that we're using as examples were stocks that I pulled from those searches. Okay. So that question comes up a lot of times. Where did you get them? I got them from those particulars. So if you're following me on X, you'll be able to see kind of first thing in the morning, usually, what some of those stocks are that are meeting the criteria of downward trending or upward trending, depending on which scan that I run. Now I want to come back, just take a quick peek at SPX, see what it's done since we put that trade. And whoa, looks like it's been dropping here, doesn't it? Does that mean our trade should be favorable or less favorable? What do you think? So we put on a short vertical. So we're up, or I should say a short call vertical, bearish trade. We were looking for it to stay below that leg, the 59.75, and 59.75 is up here. So far it looks like it's doing it. And we've only been in the trade a few minutes, and we've been able to see that erosion of the premium of that and see that time decay at work. Okay, next one up, we're going to go a little bit bearish on this one. And a couple we can choose from. Let me check this first one, see if it really is still looking more bearish. And it is. Decker Outdoors. They had earnings, disappointed, and started this big trail of some downward movement. Okay, I would see on this chart, I would say, well, we've got kind of a bearish flagpole. We had a nice little bearish flag. And today it looks like it's breaking out of that flag consolidation. Some people like to use that as an entry to a bearish trade. Some of you might not necessarily be keyed in on patterns yet, but what you might see here is that we had this short little run up, and today it looks like the price here is clearly going to close below the low of what we would call this high day here. Okay, so if that's something you're more familiar with, use that. Okay, we are bearish, so we're going to go to our call side of things, and we're going to sell a call spread here. Now, again, we're going to use our delta column, so looking in the 30s and maybe high 20s. Some people that want to be more aggressive with it might do something in the 40s. We're usually a little bit more conservative with it. Let's see if these numbers still make sense. I was looking at doing here initially the 150, 155. Now, this has some odd strike prices in it. You don't usually see a lot of that. Usually if a company's merged with somebody or taken somebody over and they have to reallocate the shares, that's when we get some interesting strike prices. Okay, and that's why I've got so many strikes open up here, is to accommodate all those little strike prices. I was looking at 150, and I believe I said 155. So 150 exactly even, where we've got a lot of open interest. Let's go ahead and just say sell vertical. Then we're going to have to go pick the right strike here. We're going to have to go to 155. So we'll come on down, and let's go ahead. Let's lock that 90 cents in. Okay, so we'd be looking to gain as a maximum theoretical gain at options expiration of 90 cents, $90 per contract. And what are we going to have to risk? We're going to have to risk $5 minus the 90 cents. All right, so we're looking at 410. 410 would be the theoretical max loss in this case. All right. Now, I'm just going to go ahead. We're going to, let's see here. We can do, let's go ahead here and do 5 contracts. That should still meet our position sizing rules. Let's go create an opposite order here, get that order ready to fill. And we're going to create the opposite order to go buy it back. And so let's do this when we get 70%. Okay, if we get 70% of the 90, only 30% is left. And I think, let's try this one more time. 0.9 times 0.3. There we go, 27 cents. We'll go buy it back at 27 cents. You can be out listening to somebody's class. You could be walking the dog. You can be having breakfast with your buddies or whatever you do in the morning or the afternoon, you know, when the market's open. If it goes in that area, then we'll let that order catch it for us and fill us. All right. We'll go ahead. We'll send this one in here to our bull. No, this one's going to go on our bear short verticals. Yep. I'm going to send that in. Now, I do hope all of you have subscribed to our Trader Talks channel. I know lots of you have. I recognize lots of your names, and so you have that familiarity with YouTube and how to find our content, but not everybody does, okay? And so what you want to do, down in the bottom right-hand corner, it says subscribe, and it has that little blue YouTube logo. Now, if you've already subscribed, don't do it again. Okay, because it'll unsubscribe you. But those of you that are maybe new or haven't subscribed yet, go ahead and subscribe. And it makes it really easy for you to find our content. You can come in here. I love this feature in YouTube when you subscribe to a channel to be able to just go and see exactly the videos pertaining to that particular channel. So here's our class going on now. And then you can see what's coming up next. So getting started with stock investing is going to be our next class. That's going to start at the top of the hour. And then you can also see what else we have going on. We got Barb Armstrong after that at the close. You can have it notify you, let you know before the class actually starts in case you happen to forget. Okay. And you can also see different playlists. You know, if you're trying to say, well, I'm really trying to get short verticals down, you can go to the playlist, find our short verticals list, and go back through some of those previous classes. Now, something that I think is super helpful for you to do is to practice in your paper money account, right? You can only learn so much by standing on the sidelines. There's only so much that you can learn. And so I'm going to encourage you to do some paper trading. You can paper trade the examples we did here today because we're going to follow up on them. You may have questions about them. Welcome to do that in your paper money portfolio or other ones that you come across. And I would say, see if you can find to practice with free in the next week before we meet again. Okay. And I may follow up with you about that and ask you how it went. All right. Let's see here. It looks like I just want to make sure we don't have any surveys, and I don't think we have any surveys out there today. Brent, thank you so much for helping me out in the chat, and especially thanks to every one of you for joining me here for our discussion on short verticals. We'll follow up on these trades and explore more in the next time we get together. Now, I moved prematurely. I want to see how our trade is doing. Let's come back to the monitor tab. Looks like it's still about 40 bucks, but look here, we brought in 45 cents. If we wanted to go shut down the obligation now, we could buy it back for 5 cents, giving the trade a net credit of about 40 cents. Okay, so those are the kind of things that are great to practice in your paper account. All right, you guys, we'll see you next week. We'll see you at the top of the hour as well. Bye-bye.